And joining me now for a closer look at what's playing itself out in that market scene is Faheema Adia from Momentum Securities. Faheema, always a pleasure. Good afternoon.
Afternoon, Alexander. Good to be back.
Yes, absolutely good to be back, Faheema. Let's get right into it. I think it's the first day of trade for the second quarter of 2024. Let's maybe reflect on what we did see in the first quarter of the year and maybe what we can possibly anticipate moving forward.
Yes, so we saw some, record gains there in the US on the S&P, the NASDAQ. Everything was obviously up and being driven by those magnificent 7 stocks and that tech rally that we saw. Going into the second quarter, I'm not sure if we're going to see quite the same returns we saw in the first quarter. We might still see a bit more momentum on the tech side, with the likes of those, the NVIDIAs, the super microcomputers and whatnot. But I do think it's starting to reach a peak point. So in terms of a valuation point of view, it's still not looking that fully priced. But I think we probably won't see the same kind of returns we've seen in the first quarter. And now with interest rates higher and the Fed likely to keep it there for a while longer, we should maybe start to see a bit of a slowdown, I think, in the stock market from the second half onwards.
I must also ask you, Faheema, here at home, it does just look like our story is battling to change at all, and that we're struggling to really reshape our narrative outside of these low valuations, but also low growth. I'm wondering, if there's anything that could possibly happen in the second quarter to change that, or really any changes are on the back of those interest rates falling, and that's possibly in Q3 and Q4.
Yeah, so I think, unfortunately, on our side, we've had a lot of local headwinds, related to the power challenges. We've had issues with Transnet, the port and railway issues there. And of course, that's been, a major headwind for our companies that are just struggling with the basics and can't really focus on anything, I think, outside of that right now. We've seen a lot of our local companies having to look outside of South Africa to try and find growth in other African markets and offshore. So I think for quarter 2, I'm not too optimistic for South Africa. Hopefully in the third quarter, once we start to see interest rate cuts coming through from the Reserve Bank, then that should hopefully then put the SA consumer under less pressure, and we can hopefully look to see some recovery there. But overall, there's very low long-term growth projections at the moment that are in place, and we definitely need to see some recovery in our fundamental factors before we, I think, can be bullish on South Africa again.
Well, that said, we have quite a bit of company news coming out today. Maybe starting off with Gold Fields. I think certainly one of the good stories of the day. Finally seeing that Salares Norte producing a first gold. I'm just keen to get your thoughts on this development and what it might mean even for the guidance here, because they have guided down in the same update.
Yes, quite a great milestone for Gold Fields. That Chilean mine has been in the development stage for quite a while now. I think it's been about 13 years that they've been working on that. They expected to see a lot of value and growth coming from this over the next few years. And I think it'll be, it's good to see this, given, the issues they've had at South Deep and some of the headwinds there. It should hopefully mitigate some of that. And of course, we're now seeing record high gold prices. So I think it's the best time to start seeing further gold production come out from there.
Just speaking about that record gold price, Faheema, I think gold trading at just over $2,200 there. Is this letting us know that markets are still actually looking for safe haven assets at this point, that there is so much uncertainty, even though we have, I think, had some very good guidance coming out of the US Fed about the future of interest rates?
I think it's just all the uncertainty at the moment, Nolitando. There's just so much going on in the world, and gold is kind of seen as a safe haven amidst all those uncertainties. So, we did see that March ISM manufacturing index numbers come out of the US, and that seemed to be stronger than what the market was expecting, which shows that the US economy is actually not cooling as quickly as we had hoped. And again, now that's led to fears that the Fed will not cut rates as soon as we had envisioned. Some economists are saying it's likely that the Fed may not even cut at all this year, worst case scenario. So I think given that, and also the escalating conflict in the Middle East, we've recently seen Israel attack Syria, and there have been some attacks in Iran. So it definitely seems the conflict there is spreading. So on the back of all this uncertainty, I think investors are just looking to gold as a safe haven.
And then an interesting one that came out today, MultiChoice has come out to say that their chairman will stay until the conclusion of the Canal Plus transaction. That tells us that there is a transaction, and it's possibly coming in at that 125 Rand, up from the 105 Rand offer that we initially saw, Faheema. Also keen to get your thoughts on this one. We had heard lots of amounts of values flying around about how much MultiChoice is really worth, but it looks like 125 might be the sweet spot.
Yes, look, it is at a premium to what the price was listed at prior to when they made the initial offering, and they obviously increased that price since then. So then what happened was Canal Plus increased their stake to, I think it was just over 35%, and then the Competition Commission said they had to make a mandatory offer to all the shareholders of MultiChoice. So that's what they now have to do, and I think they have until about the 8th of April to do that. So yeah, I think it does seem like they found a sweet spot with that price, especially considering the headwinds that MultiChoice is facing now with the, the devaluation of the naira in in Nigeria. So yeah, I think they might have come to some kind of a deal, but we'll have to just wait to see.
Another one that I found interesting, and I'm also just keen to get your thoughts here. IRR Property is a small property fund, but I think important. They've sold off all their, quite a few of their assets in the Western Cape, industrial parks, office parks. I'd be concerned as an investor here because that's the place to actually be in South Africa right now. The Western Cape is where everybody's trying to buy property. I'm just keen to get also your thoughts on that one. It is a complete cash sale on their side as well. And the Spear REIT coming to take over those properties.
Yes, it was an interesting move. I agree. It seems a lot of the growth is expected to come from the Western Cape and in South Africa in comparison to other regions. But Mira seems to think it was a good move to help it, reduce the debt in its business and to focus on other acquisitions. So I can imagine it has other ideas in the pipeline in terms of acquisitions, perhaps even offshore, because it has quite a concentration in South Africa at the moment. So perhaps the idea is to venture out and look at other markets for now. So it's mostly disposed of its industrial and office properties there to Spear. I think, given that Spear already has a focus on the Western Cape, it's probably well suited to take over that portfolio. It will definitely help it grow its presence there. And we'll see what Emira has in store for it. Its focus has mostly been on the retail shopping center side and on residential. So perhaps it's looking to just increase its focus in that area.
Well, with that said, Faheema, I'm keen to get your stock pick, but first, I'd like us to reflect on counters that have found favor with your industry peers.
I'm going for Amazon, and the reason is, I think you're getting two good stories there. I think you've got the cloud services. They've been resetting and rebuilding, and you've got this opportunity to capitalize on AI as it unfolds. They're one of the better infrastructure hyperscalers. They're positioned well to capture the margin and the expansion of that industry. And we're in a big rollout phase of that entire global infrastructure rollout, and they are very well placed to be front and center for that. That's the first thing on that side of things. And then on the retail side, they are focused, really cost conscious. They've got this strong margin expansion profile. The advertising revenue is becoming an absolute juggernaut in terms of business. And so I think you're going to see this two-pronged improvement in margins on both sides of the business. And I think there's a lot of runway there. So I like it. I think you've got a strong runway for growth, and that would be my pick.
Also sort of in retail, but a lot more, or not as adventurous as an Amazon, and that's Procter & Gamble in the US. They're a consumer goods company, and if you want to know what kind of product they sell, walk into Clicks is that kind of product, whether it be beauty or health, toothpaste, that kind of thing. So it's pretty defensive from a consumer side. And I also think it's pretty defensive from a stock perspective, because, if one takes a look at some of the valuations that we have offshore specifically in America. Added to that is the fact that they've had a consistent dividend growth of almost 70 years now. They don't reduce, they grow their dividend every year. Makes it very defensive and very well managed as far as I'm concerned, and the graph looks good.
All right, Faheema, keen to get your thoughts on that one. Amazon, but also P&G, haven't heard about that one in a while.
Yeah, so on Amazon, we like this one too. I think it has a lot of potential for growth. We're looking for earnings growth in the long term of at least 30%. And like the analyst said, cloud services division is expected to perform quite well. It's making very good progress on the AI side. And once inflation starts to come off later in the year, we expect to see a consumer that's under less pressure, and there will probably be more spend than for non-discretionary items, which should positively impact the retail side of Amazon. And then looking at Procter and Gamble, that also I think is a safe bet, considering that it is a defensive stock and the environment we're heading into is full of uncertainties at the moment. So if we do see the Fed hold interest rates higher for longer, it could result in a bit of a slowdown there in the US. And generally, when there is a slowdown, defensive stocks like Procter and Gamble will usually do better. And on the other hand, once inflation starts to come off, like I said, the similar case with Amazon, will have a consumer that's then under less pressure and able to spend a bit more on non-discretionary purchases. So I do like both.
And with that said, which counter are you loving this afternoon?
So today I'm looking at AL Technologies. It's actually a Taiwanese firm that is also in that global AI supply chain. It stands to benefit quite a bit given the AI boom. So what this company does is it's involved in IP and design services for semiconductor chips. It's quite important given that chip performance is largely dependent on the quality of IP and the design. It stands to be quite a key beneficiary when it comes to these customized chips from the likes of NVIDIA. And if we look at the valuation, we're expecting pretty high earnings growth on this one over the next few years, with about 44% expected. And in terms of our valuation upside, we're looking for at least 50% on the stock.
Well, always a pleasure having you right here with us on Business Lunch. Faheema, thank you so much. That was your midday markets update with Faheema Adia from Momentum Securities.